Stop what you're doing. Because if you have a 401k, an IRA, a brokerage account, or you just care about what's happening to your money, today might be the most important day you watch this channel. It is Monday, March 9th, 2026, and right now, the United States stock market is in full meltdown mode. The S&P 500 has just crashed to 6,666 points. Yes, that number is real, wiping out every single gain it made in 2026. The Dow Jones lost over 600 points in pre-market. Nasdaq futures are down 1.1%. Oil briefly spiked to $119 a barrel, a level we haven't seen since 2022. Silver just crashed over 10% in a single day. And last Friday's jobs report showed the U.S. economy lost 92,000 jobs in February, the worst number in years. In this video, I'm going to break down exactly what is happening, why it's happening, and what it means for your money right now. We're covering the S&P 500, SPY ETF, silver, oil, the jobs report, the Fed, and I'll give you the key levels to watch going forward. Stay with me. This is a big one. Let's start with the big picture. The S&P 500 right now is sitting at 6,666, and that's not a typo. That number represents a 3-month low for the index, and more importantly, it has officially erased every single gain the S&P 500 made in all of 2026. We are flat to negative for the year. Gone. Done. The SPY ETF, which is the most popular way regular Americans invest in the S&P 500, fell 1.31% on March 6th and is continuing to slide today. Over the past 5 trading days, SPY has seen $11 billion in net outflows. That means investors are pulling real money out of the market fast. Let's put that in context. Last week, the Dow Jones Industrial Average dropped 3%. That was its steepest weekly decline since April 2025. The S&P 500 dropped roughly 2% in the same week. The tech-heavy Nasdaq 100 fell 1.5%. And now, heading into this Monday, things are getting worse. Here's a technical signal that's got traders alarmed. The DIA, that's the Dow ETF, has just broken below its 100-day moving average for the first time since June 23, 2025. That's a significant breakdown in market structure. Technicians will tell you this is not just noise. This is a serious warning sign. Now, despite all this, here's something interesting. Retail investor sentiment on SPY remains positive according to StockTwits data. Everyday people like you and me are still optimistic, or perhaps still in denial. But hedge fund sentiment is a different story. Institutional players are pulling out. One analyst on StockTwits is now targeting $652 on SPY as the next major support level. SPY is currently trading around $668. If that $650 level breaks, we could see a much deeper correction. According to TipRank's consensus of Wall Street analysts, SPY still has a moderate buy rating with an average 12-month price target of $830.45. That implies 23.5% upside from current levels, but nobody's making money waiting if this thing keeps falling in the short term. Now let's talk about what is actually causing all of this. The single biggest driver of this market chaos is oil, and the reason oil is exploding is war. On February 28, 2026, the United States and Israel launched coordinated military strikes on Iran. Since that moment, Brent crude oil has surged 66%, and WTI crude has surged 77%. Think about that, 77% in less than 2 weeks. On Monday morning, today, Brent crude spiked to $119.50 a barrel, its biggest single-day price jump in absolute dollar terms in history. WTI briefly hit $119.48 a barrel as well. That matches levels we last saw in 2022. All-time highs were around $147 back in 2008. We're not there yet, but the trajectory is frightening. Here's why this is such a massive deal. The Strait of Hormuz, a narrow waterway between Iran and the Arabian Peninsula, is the most critical oil choke point on the planet. Roughly 1/5 of the entire world's oil and liquefied natural gas flows through that strait every single day. Right now, it is virtually shut. Ships cannot safely pass. The ripple effects are catastrophic. Iraq's oil production from its main southern oil fields has collapsed by 70%, sources told Reuters over the weekend. Iraq, by the way, produces nearly 4 million barrels a day. Kuwait has cut production and declared force majeure on oil shipments. Saudi Aramco has begun cutting output at 2 of its major oil fields. Qatar has stopped LNG production after attacks on its key infrastructure. There was a fire at the UAE's Fujairah oil zone, and Bahrain's Bapco refinery has declared force majeure after being attacked. Goldman Sachs estimates the market is pricing in an $18 per barrel geopolitical risk premium, and that's based on the assumption of only a 6-week full disruption. If this goes longer, that number goes higher. Meanwhile, Iran has named Mojtaba Khamenei, the son of the former supreme leader, as the new supreme leader. He is a hardliner. That signals Iran is not about to soften its position. This conflict may not end quickly. The G7 nations are now reportedly discussing tapping strategic petroleum reserves through the International Energy Agency. Former President Trump has said the oil price spike is an acceptable cost for security. The Senate Minority Leader has called on Trump to release U.S. strategic reserves. But as one UBS analyst said, quote, alternatives are limited. In comparison to the potential magnitude of the supply disruption if the Strait stays closed longer, they are a drop in the ocean. For everyday Americans, this means gas prices at the pump are going up. U.S. gasoline contracts just hit their highest price since 2022 at around $3.22 a gallon. That's going to hit consumers directly in the wallet. Now let's talk silver, because this one shocked a lot of people. Silver had been on an absolute tear in 2026. At its peak just days ago, silver hit nearly $96.50 an ounce. People were calling for $100, then $110, maybe even $120 by the end of the year. And then, boom. Silver crashed more than 10% in a single session, dropping below $80 an ounce for the first time since February 20th. At the time of recording, silver is trading around $80.68 to $83, and technically, it's looking very weak. Why did this happen? This seems counterintuitive. You'd think war in the Middle East, fear in markets, people running to safe havens like silver and gold. And yes, that logic makes sense. But here's what overrode it. Number 1, the US dollar surged. The dollar index, DXY, climbed to its highest level since January 19th. Since silver is priced in US dollars, when the dollar gets stronger, silver priced in dollars goes down. Simple math. Number 2, Treasury yields rose. The 10-year Treasury yield rose 1.2%. Silver, like gold, is a non-yielding asset. When yields rise, investors prefer bonds over precious metals. Money flows out of silver into treasuries. Number 3, inflation expectations from oil are actually hurting silver. Here's the irony. Higher oil prices mean higher inflation fears, which means traders now expect the Federal Reserve cannot cut rates and may even have to consider hikes. Higher rates, darn bad for silver. This is what Commerzbank's analyst Thulan Nguyen explained to Reuters. The market is now placing greater weight on inflationary risks from the war, raising interest rate expectations. This also explains why the US dollar continues to gain ground. Technically, silver has broken out of a rising wedge on the 4-hour chart. The RSI has dropped toward 30, near oversold territory. The MACD is flashing red. Key support levels to watch, $78.25, then $72.32, and in a worst-case scenario, $64.08. On the upside, resistance sits at the 100-period SMA around $83.20 and the 200-period SMA near $88.80. Some analysts, including Citigroup, had forecast silver hitting $100 by March 2026 and $110 by end of Q2. That call is now under serious pressure, but if the war de-escalates, silver could snap back violently, so keep your eyes on it. Now here's the gut punch that came right before the weekend, the February jobs report, and it was absolutely awful. The Bureau of Labor Statistics reported on Friday, March 6th, that the U.S. economy lost 92,000 non-farm payroll jobs in February. Let me repeat that. Lost 92,000 jobs. Economists were expecting a gain of 50,000 to 59,000 jobs. The actual number came in at negative 92,000, a miss of over 150,000 jobs relative to expectations. That is massive. The unemployment rate rose to 4.4%, up from 4.3%. January's numbers were also revised downward to 126,000 jobs added, originally reported higher. Some of February's weakness was blamed on harsh weather conditions and a 41-day nursing strike, but even accounting for those factors, the trend is clear. The U.S. labor market is weakening. This jobs report matters enormously for 2 reasons. First, it tells us the economy is slowing down. Fewer jobs means less consumer spending, less corporate revenue, lower earnings growth for S&P 500 companies. Second, and this is the cruel irony, this bad jobs report would normally make investors bet on Fed rate cuts, which is good for stocks. But right now, the oil price explosion means the Fed is stuck between a rock and a hard place. The Federal Reserve currently holds rates at 3.50% to 3.75%. They held in January. They were expected to hold in March. But here's the stagflation trap. If the Fed cuts rates to help a weakening labor market, it risks pouring fuel on the inflation fire being ignited by 100+ oil. If it hikes or holds, it suffocates a slowing economy. There is no easy answer. Morgan Stanley, JP Morgan, and other major banks have been warning about this exact scenario. JP Morgan Global Research now puts the probability of a US and global recession in 2026 at 35%, and that was before this week's oil shock. So what happens from here? What are you watching this week? Wednesday, March 11th. The Consumer Price Index, CPI, is released. This is our most important inflation reading. If oil prices are already bleeding into consumer prices, this number could come in hot. A surprise to the upside would crush any remaining hopes for Fed rate cuts in 2026. Friday, March 13th. The Personal Consumption Expenditures, PCE Index, the Fed's preferred inflation gauge, is released. Same story. All eyes on inflation. Corporate earnings this week. Hewlett-Packard Enterprise reports after tonight's close. Oracle reports later this week. Interesting because Oracle is listed by TipRanks as one of SPY's top holdings with the most upside potential. Also watch Adobe and Dick's Sporting Goods. Key levels to watch on the S&P 500. The critical support right now is around 6,600 to 6,650. If that breaks, analysts are targeting the 6,400 to 6,500 range as the next floor. On the upside, SPY needs to reclaim $680 to stabilize sentiment. On oil, if WTI stays above $100, inflationary pressures will continue to build. Watch for news on G7 strategic reserve releases. That could temporarily knock oil down. But until the Strait of Hormuz reopens, the supply crisis is structural, not temporary. On silver, the 78.25 level is the line in the sand. If silver breaks below that, the next major support is $72. If tensions de-escalate and the dollar weakens, silver could bounce sharply, potentially back toward the $88 to $90 range. Now, let me be very clear. I am not a financial advisor, and this is not financial advice. This is me giving you the same information that institutional traders and Wall Street desks are looking at right now. Here is the framework smart investors are thinking through right now. Energy and defense stocks are among the few sectors trading higher in this environment. Names linked to oil production, defense contractors, and energy infrastructure are getting a bid. That's where the money is flowing right now. Retail investors, according to StockTwits data, are still showing positive sentiment on SPY. They're buying the dip. Whether that's brave or premature depends on how quickly this geopolitical situation resolves. Hedge funds, on the other hand, have been pulling capital out. $11 billion in 5-day outflows from SPY doesn't lie. The smart money is reducing risk. Gold. Interesting note here. Despite the war, gold actually pulled back too, falling 2% to around $5,213 an ounce. The stronger dollar offset the war premium on gold, but gold is still near all-time highs. The long-term picture for SPY remains intact according to Wall Street's 12-month consensus. That 830 price target implies 23.5% upside from current levels, but nobody knows how long this crisis lasts. The bottom line, volatility is your new reality. Do not panic sell, but do not pretend nothing is happening. Review your risk tolerance, know your key levels, and stay informed, because in markets like this, the most valuable thing you have is knowledge. That is your complete March 9th, 2026 market update. Oil over $100, silver crashed 10%, the S&P 500 has wiped out all of 2026's gains, 92,000 jobs were lost in February, and the Fed is trapped in a stagflation corner. This is a lot, but now you understand the full picture. If this video helped you, smash that like button. It genuinely helps this channel reach more people who need to know what's going on with their money. Subscribe if you haven't already. We cover every major market update with real data, real sources, no fluff. Drop your question in the comments. Are you buying this dip in the S&P 500 or waiting on the sidelines? I read every single comment. Until next time, stay sharp, stay informed, and protect your wealth. Peace. Disclaimer. This video is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy, sell, or hold any security, ETF, commodity, or asset. All data and figures are sourced from publicly available information as of March 9th, 2026. Markets are highly volatile and unpredictable. Past performance does not guarantee future results. The creator of this video is not a licensed financial advisor, broker, or investment professional. Always conduct your own due diligence and consult with a qualified financial professional before making any investment decisions. The creator assumes no liability for any financial decisions made based on the content of this video.